Okay, Google, when's the seminar going to start?
It's time. The seminar is starting right now.
Welcome, everyone. It's wonderful to see you all back. Thank you for coming to the Coco TAN Tuesday afternoon networking live stream seminar. We're also streaming live on Facebook, YouTube, 一直播, Weibo, and TikTok. We will be recording this Zoom meeting for YouTube, but we're so glad you're here joining us live. Hi, my name is Coco Tan, and I'm a realtor with Keller Realty in the San Francisco Bay Area. If you wish to receive the latest videos and seminar updates, please feel free to subscribe to my YouTube channel. I have a big QR code here on my wall. And here's my WeChat and WhatsApp QR code. Please feel free to add me. I'm so happy to be hosting the second session in our Think and Stay Rich series. It's December, which means 2020 is coming to an end. While taxes are not due until April, you have less than 1 month left to make decisions for this financial year. Do you have a strategy this year? It's time for short-term tax planning. Tax planning is the analysis of a financial situation or plan from a tax perspective. The purpose of tax planning is to ensure tax efficiency. Tax efficiency means reducing tax liability and maximizing the ability to contribute to retirement plans and other tax saving and tax deferred investment vehicles. What can you do in the short term to legally limit your tax liability? Whatever your strategy is, it might not be exactly the same as what you did last year. For most of you, 2020 felt a little different than 2019. The pandemic has affected us as individuals and business owners. There has been an election with new bills and propositions. You may be wondering if any of the mandates and tax codes have changed. Tax codes are filled with traps. If you claim too few deductions, it will cost you money. And if you claim too many, the consequences may be worse. Good news, our CPA is up to date on this year's tax laws. He will share his knowledge to allow us to create an informed tax strategy. Backed by popular demand, Mr. Bin Zhai is a CPA, CFP, MBA, and partner. For over 25 years, he has helped grow startups. Mr. Zhai specializes in tax planning and preparation for individuals, trusts, and corporations. He also does financial planning and wealth management for high net worth clients and business owners. Mr. Bin Zhai is very generous with his time and knowledge, so he hosts annual tax planning sessions for his own clients and followers. The up-to-date information he shares every year is invaluable. Fortunately for all of us, this year I am partnering with him. His annual tax planning session is combined with my TAN seminar that you are all attending here right now. We hope our partnership will give you the best of two worlds. I cannot wait to hear what he has to say. Please welcome my distinguished partner, Mr. Bin Zhai.
Okay, this is Bin Zhai. Hi, everyone. It's a full house almost here. I really appreciate that I can join the effort with Coco TAN Realty Group. And we have a record participant over 100 now, really appreciate it, Coco. And is that okay? I share my screen right now. I have a lot of a slide to go through today. So today's agenda, can you see it now?
Yes.
Okay, cool. So my name is Bin Zhai. I'm a partner with the Zhai & Wang LLP. We specialize in small business and the high net worth individual and professional in the Bay Area. We help individual tax, corporate tax, and accounting and payroll, as well as wealth management. And every year we do two seminars, one in the end of the year, one in the beginning of the year. And this year, we think we still want to keep the tradition. Amazingly, with technology, we can reach more people. And as far as I heard, my client in the East Coast or even in China, they may be participating too, because we don't have a time and the space barrier anymore with a virtual learning, And so without further ado, I just go on with a one quote by President Ronald Reagan. It also reflects our today's seminar. Ronald Reagan used to say, you cannot tax business. Business doesn't pay tax, it collects tax. So what it really means is RS leave a lot of tax code benefit for the individual who have their own big business, or for the big business hire individual. They are the core organization for the economy, for people to earn salary, for to generate the production, and they are the core. So throughout my presentation, you will see we can list many of tax deduction for business, but for individual, probably very few. But we still found some. So our next slide of this page over here is what it's coming from my real experience at the time like this. We are about to go through the holiday, and 2020 as a year, it's gonna be over, okay? So at the end of the year, normally I have a clients ask me, how do I save tax? My first answer is, did you put enough money contribute to the 401k? Because for the individual, this is still the biggest deduction. And for individual, you can put away $19,500. For anybody over 50-year-old, you can put away $26,000. If you haven't done that, if you still have 2 payroll checks, please go to your HR or payroll. Tell them you want to put it as many as your net pay, the take home pay, to your 401k, so you can skip the top rate, which is your marginal rate. And the second way to do the deduction for the individual is a holiday time. You should optimize your donation. And due to the tax change, a lot of people use 2 strategies right now. One is called bunching. Bunching means if you only donate a very small, you probably can think about it to put several years donation together in 1 year. For those people cannot donate enough for their on the itemized, because right now itemized deduction is $24,400. So that's the better way to give to the charity organization who help the people who in needs, and you also can increase your deduction. Second way is called QCD. This is really for the retirement folks over 70-year-old. If you have a big RIA, you can donate up to $100,000 from your RIA money to get the tax deduction. I really advise a lot of retirement folks who don't need the money, but still need to help others, and also want to lower their qualified amount. Although there's no required minimum withdrawal for 2020 by the new CARE Act, but you can use this to do the donation. I have another strategy to, if you should think about to convert to a Roth IRA for the year, you don't have a required minimum withdrawal, okay? So for the folks in their retirement age and over 70, you can direct donate your RIA to charity and get up to $100,000 deduction. The third way is not to save tax, but to avoid the penalty. You know, a lot of business owner and the high income owner that doesn't withhold enough tax. So when we prepare tax return during the tax season, a lot of people has to pay the estimate tax penalty. You know, particularly right now, if the money is sitting in your bank, I recommend you to give those money to IRS if you haven't met your minimum withholding rule yet, because any money you save in the bank will not generate enough equivalent amount. The IRS gonna penalize you, you know, because saving rate are really low. But for those W-2 earners, you should think about, take a look at your minimum tax. It's called a safe harbor rule. Normally, you should pay as much as the tax you pay in 2019. Okay? If your income is over 150, that amount is 110% of the tax you pay in 2019. And so if you have that figure in your hand, and take a look at your last paycheck, if you still a little bit shy from with that number, you should put all your income, enough income to defer those through your W-2 check. The good thing is to pay from the W-2 checks is IRS will not consider you paying late at the end of the year. They will consider you pay it at any time during the year. So you won't be considered as late. So it can avoid the penalty, okay? I also receive a lot of calls from my client, either they qualify for the stimulus check or somehow they didn't get the money. I just let you know, IRS already announced there's a pandemic tax credit on 2020's tax return. All you need to do is to file a tax return to prove you don't have enough income. This probably goes well to those college student. You know, if your parents doesn't have too much tax benefit to claim you as dependent, you probably can file your own tax return. Or the people who doesn't have a job and their income going low, you can qualify for that $12,000 stimulus check. So don't worry if you don't get the check. You make sure pay to file a standalone return for year of 2020, okay? And right now, everybody knows your employer have a benefit of open enrollment. I strongly recommend all the employee to participate. To save tax, there's a two pre-tax plan, either as a FSA plan or HSA. One is called the flexible spending plan. Another is called a health saving plan. Will help you to save on your top rate too. You know, so if you think you will spend those money either on child care or medical expense, try to use either FSA and the HSA. And just on my side notes here, I will prefer a HSA plan because HSA plan is the only plan in the IRS code allow triple tax free, okay? So the money goes into the plan, you skip tax. The gross, you skip the tax. If you didn't spend all the money before ends, you know, all the money your here inherited, they will get tax free too. So three times there were no tax, even better than the Roth IRA account. Okay. And also for small business owner, if you want to set up some tax advantage, the plan normally is qualified plan or retirement plan. You have to do it before end of year. After the end of the year, even I have a good recommendation to help you to save 10, 20, or 25% of tax. During the tax season, they are not qualified because you didn't set up the plan. IRS require some qualified plan to be written down by the end of the year, okay? And also, For the individual, there's a few after-tax saving idea. Like if you have kids, you are commitment to help them go to the college. 529 plan contribution has to be made in before end of year. And the Roth IRA conversion, I know a lot of people doing the Roth IRA because in 2020, they didn't make that much money, either got a layoff or staying home. It's good time to convert those otherwise taxable RA account to the Roth RA, but all the conversion has to be done by the end of year, okay? Otherwise, if you do in 2021, it will become 2021's conversion, not 2020. Although you can still make the contribution for RA in the tax season before April 15, but conversion has to be done by the end of the year. And there's also a lot of big company in the Bay Area have things we financial planner called a MAG backdoor Roth RA. That means you can take advantage the after-tax contribution in the 401k and immediately convert them to the Roth 401k. That limit are really high. RS actually allow $57,000 for the individual under 50 and the $63,000 for anybody over 50-year-old. So this page here, although very crowded, is the idea we have for the individual. So individual, if anything apply to you, please do it before end of year, okay? So, and we want to start to talk about it for the business owner. We have a lot of business audience over here, and what can you do for the business owner to get the deduction, okay? And there in the business, a lot of clients always hear me talk about, are you a cash-based business or you accrued-based business? What I mean is, if you are cash-based business, anything you collected will be counted as a revenue. Anything you didn't deposit, you haven't collected, they will not count as a revenue, okay? So if you are a cash-based earner, you can defer billing and the collection for the product and the service until end of year, so you won't be taxed. If you accrued method business, means no matter you collect or not, as long as you delivered product or the service, then count as a revenue. So you can think reversely, as long as I don't deliver the product or shipping, if I don't shipping the product or I don't deliver the service, it will not count as a revenue. So you can defer your income to next year, to the beginning of the year, okay? And also, by that way, you can also accelerate the business expense by paying for the purchase and any credit card charge. Although all the credit card charge you haven't paid, as long as you put it on the credit card statement, they will count as a current year's expense. And if you are self-employed earner, I sometimes recommend my client to hire their account, because anybody under the 17, you don't have to pay the payroll tax. Those only qualified for the individual who filing the Schedule C. If you have a corporation, if you hire a child, you still have to pay the payroll tax. Only the self-employed owner doesn't have to pay, you know. And we're also going to talk about the home deduction. I have a slide for the home deduction since we all working from home right now, you know. And so we will stay tuned for that. Another way for the business owner to get more deduction is to acquire necessary business fixed assets. Okay, So acquiring business assets may be a good tax planning strategy, depends on your business situation. Okay, all the assets where you have a useful life more than a year, you generally can depreciate the whole cost over the year. But on the Trump's tax reform from the Job Act in 2017, there's a favorable tax provision allow you to deduct everything. Okay, one is called Section 179 in the IRS code, is expensing election. This election allow you to deduct 100% of the cost of a qualified assets rather than recover them through the depreciation. The maximum amount you can be expensing for 2020 is a 1.04 million. It's almost it's over $1 million if you need to purchase that much. Okay, and the amount is reduced but not below the zero by the amount by which the cost of total qualified expense, as long as all the fixed assets not exceed $2.59 million. Okay. There's one better rule called the bonus depreciation. It's also passed by the Trump's Tax Act, established 100% first year deduction for the qualified assets placed into service as long as before December 31st with a recovery period of 20 years or less. Okay, so this provision apply for both both the new and the used property. If you buy something already pre-owned, it qualified that too. In the previous tax code, they won't allow this, only the new one. But the new bonus depreciation, previous owned anything, including the qualified, the film, television, living theater product, they all can be deducted. And also, it's also including a 6,000 pounds heavy used vehicle, so some SUV over 6,000 pounds, as long as you buy by the end of the year and put into this service, you can deduct the whole cost of the car based on the business use percentage of cost. Okay. So, and also I already said in the beginning, we recommended the business owner to take a look. If you still have a lot of income, you can defer some income through the qualified plan or self-employment plan by the end of the year, but those plans has to be created by the end of the year. And also consider, so those are the 401k plan. If we have time, we can talk about that. That's the main practice I often help our client to defer a lot of the income against their otherwise paying highest rate business revenue. And also with Trump's tax law, I don't know how long it's gonna live, but there's one section called the 199 Cap A deduction. This is allow sole proprietor and the pass-through entity owner to defer any income over 20% will not be taxed on the federal rate. So if you have a C corporation, LLC, and the S corporation, and the K1 income, as long as they are domestically qualified business income, 20% can be exempt. And I only recommend that people can leave enough money to go through that calculation. That is very conclusive calculation, very complicated, but it really yields 20%, which is a lot of tax deduction. Okay, and let's go through another slide. I in the beginning I mentioned, since we are working from home and business working from home, the deduction is very important, but I have to warning for those W2 earner. Home office, they used to be deductible, but Donald Trump repealed that. So he took out the whole section and this in the itemized deduction for miscellaneous deduction are gone. So you, for the W-2 owner who working from home, you won't be able to deduct that already after 2017. So I don't know any tax law will change. I haven't seen anything. So our only recommendation, if you're working from home during the pandemic, the best way to get a tax deduction is to ask your employer to reimburse you for the home spending cost, okay? But you are self-employer, particularly for those Schedule C filer, you are allowed to claim part of your resident for any direct and indirect cost associated with upkeeping of your house, such as mortgage and the property tax. Everybody knows the property tax for a lot of California, only $10,000 now for everybody. So our property tax bill may be much higher than the $10,000, but if you can show the way some property home you use as a business, you can turn those otherwise cannot deduct the property tax to be a business deduction. And also repair, maintenance, the utility and the internet insurance and the home office use. And also the last biggest one is California houses are very expensive. You can also claim the depreciation by the space what you the use over here. But just remember, you only can depreciate over 39 years straight line. A lot of people, they're using TurboTax or whatever, they're still using residential deduction for 27 years, which was wrong, okay? If you get an IRS, they can change you to 39. So if you divide by 39, the number gonna be much smaller than any number divided by 27.5, so. And the key to deduct the home office is to have a good measure of your footage. And some item you should claimed by the hours of use. Those particularly for people who have a child care in your house. A lot of them, they using the time. And also for the corporation owner, we suggest to have some sublease agreement between the owner and their business. If you're working in home, you should issue the Form 1099 to the shareholder and the owner as a rental. Then you report those rental for your home you use over here. So it's a better way to track your home business than just to Form 8829 deduction, okay? And also, since we are in the year end and the Biden administration gonna empower, declared as a president, and we predict there's gonna be a lot of change, and some change is not very good to California, particularly in the Bay Area over here. I think by Biden, those are only the prediction, and we don't know what's gonna change. We just put over here as a discussion, as a people to be aware what he gonna do, okay? I think that the Biden tax will repeal some 2017's tax reform they made for the affluent. We can take a look at the remaining what the Biden means for the affluent, okay? And we also think the highest tax rate, 39.6 before Trump time gonna come back, okay? And for any high income over $1 million, I think they talk about to make the capital gain tax and the marginal tax are the same. That means if you sell the stock option over $1 million or some stock, which is a very common thing in the Bay Area. You could pay the highest rate. And they don't have a capital gain. That what the Democrat talk about. And also for the earner over 400K, they were capping the itemized deduction at 28%. That means you will not get the full deduction. You only pay at 28%. So I guess the affluent under the Biden's rule is anyone earned over 400K. Okay. And also for anybody owned over 400K, they also want to tax again for the Social Security. So the Social Security for the people already top off at the 130K about. I think if they enacted this to allow the Congress tax the Social Security for earning over 400K, that will be a lot of tax revenue for the government since they printed so much money. So they have to think about a way to get the money back. So that's very deadly. You know, I know a lot of people in the Bay Area over here, they are combining household income very easily over 400K. And the Biden maybe also to eliminate the real estate loss deduction. Throughout the Trump administration, we are always joking and talk about Trump only pay $700, $758 for some year. The key he wouldn't be able to, he doesn't need to pay that much, is because he has a lot of rental loss, real estate loss over here. So I think it's gonna be eliminated to limit the real estate loss deduction. And the federal wage gonna be $15. I think this gonna have a lower impact on California because a lot of the city over here already pay $15. So our business owner should be no worry about it. But still a lot of money for running the business now. And also the federal government will come out to sponsor a 401k plan. A lot of a small business, they don't have a 401k plan. So make a lot of American workers, they have nowhere to put away their highest income. So the government is thinking about to sponsor the plan, okay? So this is, and this, we almost towards the end. We have another slide is over here. There's something special for 2020. 2020 gonna live in the history for very special years. And with the swift passed of a CARE Act during March, Congress allowed a lot of a deduction. I put over here is really something for the small business owner. A lot of my client already applied the PPP loan, and we are in the process to get those PPP loan forgiven. Okay, so try to finish those as soon as end of year. Okay, and the CARE Act also accelerated business who can claim their unused AMT. Now, in the past, you need to take like 4 or 5 years to claim the unused AMT. Right now, you can accelerate it to claim it in 2020 right now. And also, Trump's tax reform in 2017 eliminate all those net operating loss carry back. But with the CARE Act, if you suffer the significant loss during the last 3 years, including 2020, you can carry them back all the way for five years. In the past 5 years, if you make money, you can get the money back right now. And the law also allow quick refund for disaster loss caused by the COVID-19 and the fire in California now. And also, there's another very special rule, which is called the quality opportunity zone, which allow the owner whoever to have a significant capital gain tax to be deferred and invest in those qualified zone. You can also exempt some future gain. We have another seminar in tomorrow to talk about this, which is a qualified zone. This in the last 2 years, we've been have a client to ask this and use this advanced tax strategy, is how to save capital gain tax. A lot of people have been having a lot of a capital gain because the stock market have a game bust wrong, you know. So all those capital gain, if you think about how to have a way to lower the tax or defer the tax on the certain percentage, you are welcome to come tomorrow. I have another seminar there to talk about this capital gain tax. It's a busy end of year. All my client already got the notification. If you are interested in it, you can scan the barcode over here. So tomorrow we will have a special list from inline real estate security to talk about qualified opportunity zone. And we think such real estate heavy strategy will be will have some impact of Biden come to power. So it's as early as the end of 2020, it could be stopped, you know. So just beware, you know. So this almost reach end of my presentation. In the last presentation, I just want to show some slide that we compiled over here, let people understand what's the framework of a U.S. tax system. So the first chart I list over here is a single tax rate versus joint married joint rate. Okay, so so for U.S. there's a 7 tax bracket. Depends on your income, your taxable income. You can pay between tax rate from 10% to 37%. So for individual who earns more than 160, you will pay 32% already. For the married couple, that number is starting from 326K, okay? And the highest rate is 37%, okay? Individual make over $500,000, married couple make 622, we'll see they pay highest rate. And that highest rate also gonna impact on the capital gain too. So we're gonna talk about it a little bit over there also. So in the next slide is a long-term capital gain. So as we said, a lot of people not only make money on the W-2 side, they also sell a lot of stock. So if you sell the stock, you hold more than 12 months, if you hold it less than 12 months, your tax rate is gonna be the same as what we see on the tax bracket. You pay on the marginal rate. But if over 12 months, 365 days, more than by 1 day, you pay the long-term capital gain tax. Long-term capital gain actually has a 3 levels rate from 0%, 15% to all the way 20%. And there's another hidden rate called the Obama tax. If you over 250K individual, 200K for individual, any capital gain or dividend or some rental income, there's a 3.8 net investment income tax. So just take a look at the rate over here. There's a big tax planning. If you're gonna hit the higher, maybe you can hold off the selling, or you can consider the seminar we're gonna talk about in tomorrow to defer some rate without paying that. Okay, so there's some tax advantage there. I also want to talk to not that everybody make their money. For the old folks, if they are retired or they didn't make money, you can sell some stock as long as your taxable income under 400K and your capital gain is not blow you out more than 40,000 individual, 80,000 for the married couple. All the stock you sell as a long term, you pay zero tax. It's almost tax free. Okay, so so by the end of the year, think about their tax rate to do some tax smart way investment. And also there's a deduction over here. Normal people, if you don't have a big house or big deduction, itemized wise, you can deduct individual $12,000, $24,800 for joint couple. For head of a household, a single parents, it's $18,000. And each kids can earn you under 17, $2,000. And the South means state and the local tax only cap as a $10,000. Okay, so those are useful number to do the tax return. And another useful number is to, I said in the beginning, to save tax 401k and the tax advantage, the RA account. It is the way you to save tax. So I list a table over here for individual. You can deduct 19,000. We already talked about over 50, another 6,005 catch-up deduction make the $26,000. RA at the $6,000. Over 50 is a $7,000. If your income qualify you to do a Roth RA, to do a Roth, it's the same as traditional. So if you do both RA and the Roth, they combine cannot over $6,000 or $7,000 for the 50. So you take either pre-tax or after-tax, or combined cannot be over $7,000. And also talk about the HSA account. For a family, you can contribute the 7,001. Anybody over 55, as long as one spouse over 55 can contribute 8,001, and you can contribute as late as when you're filing the return, which is April 15th. So those all can skip on the top rate. So this concludes all my presentation over here. And Coco, are we still there?
I'm here.
Are you falling asleep?
No, this is very.
Okay.
This is
So a
great.
lot of number very boring. So maybe we can go into some Q&A now. So.
Sure. You can go ahead and
So
share.
while you take a look Q&A, I just put our company's WeChat code over here. If you have any question want to discuss privately, you can give us a call.
I've been that the QR code has expired.
Yeah, Bill. What's the question?
The WeChat QR
the-
code expired already.
Yeah.
Oh, really?
Yeah, I tried.
I
Right after.
I should do some other. Sorry, I'm not very good to do this.
I can. What I can do is I can get you in there. So
Sure.
whoever wants to
Okay.
get in there, you can email me. If you hear from me.
Yeah, if you have a Coco's group, you can go that group and jump to.
Yeah, I will ask Coco to add me. Yeah, thank you.
Yeah.
Yeah, Coco has a lot of barcode there.
Okay, yeah.
Get me to get you.
Well,
Okay.
Of
Okay.
course.
So, okay.
Yeah, I could do it early. Okay, never mind that.
Okay.
So I just switch to my beginning. You can always call me and email us then, you know.
Sure.
All right. So
That's very valuable information. Thank you so much, Bin.
sure. Okay. Thank you.
Thank you. So we have been streaming live on Facebook, YouTube, and other platforms.
Mhm.
Today we also have compiled, or you want to go ahead and share your screen?
Yeah. While you talk, then
Okay,
and share nice.
thank
Okay.
you. So we have compiled some questions our viewers have for our guests. Before we get into the question and answer session, I would like to give you a quick preview of our next session in the Think and Stay Rich series, where the topic is the California Proposition 19 and what it means for you. Joining us will be Mr. Michael Lee from RUI Attorneys. Hi, Michael. Are you online? Can you give us some quick sneak peek of what we can expect from you next Tuesday?
Greetings, Coco, and greetings all. It's great to see all of you. So for Proposition 19, basically it's a new world. I think everything that you and your group is probably familiar with regarding parent to child transfers for real property, much of that has all changed. So the way that you have generally thought of how to transfer property from parent to child, after Prop 19, which is February 15th, 2021, everything's going to be different. So we have a narrow window of about 2 months of things we can do. So come join us, and then you'll learn whether you should make a transfer, whether you should keep it the same, or whether you should advise your friends and relatives, because a lot of times this may be okay for you, but you may think, oh, this may be important for my parents to do, or my brother or sister or someone to do. So join us, you'll learn all about that, and you'll learn whether to keep the title the same or to make a change.
Great, thank you, Michael. Of course, Proposition 19 also have things to do with property tax spaces, and I think you will touch base on those as well.
Oh yes, there's also some great opportunities, like I mentioned before, for your family. For older persons, they can now keep their property tax basis and move to a new home and keep the property tax basis and not have to worry about an increase. So we have lots of good things. You can make transfers, or you can move now if you're over 55 or certain categories. So a lot of good things coming forward, and we look forward to telling you all about it.
Thank you, Michael. So be sure to join us next week on December 15th. Of course, tomorrow, our CPA Bin Zhai will have a special session on how to save capital gain taxes. So don't miss that as well. So you can either reach out to Bin or me to get the meeting information. Now it's time for the Q&A. If you have a question for them, type it in the chat or use the raise your hand feature in Zoom. I have a question that was emailed to us before from Julie. I recently sold the property at Arizona. Should I pay the capital gain taxes before the end of the year? Which form should I use, Mr. Bin Zhai?
Okay, those goes by the bullet item. I said you should pay enough tax to cover your minimum liability. Okay, so you should pay enough tax to cover 90% of the tax you would pay for 2020, or 110% of the tax you pay in 1919. So 2019. So you shouldn't look at the compartmentalized way how much capital gain I pay for the house. You should look at your overall how much tax you need to contribute as an estimate tax. So take a look at your 2019 tax return. Take a look at your tax liability. Your safe harbor number is use that number to multiply by 110%. That's the minimum tax you need to pay before you could incur any penalty.
Okay. So the stimulus check is $1,200, not $12,000.
Yeah, $1,200. Sorry if I typed it wrong. I don't think IRS government gonna afford that much.
Yeah. From Nima, hi Bin, my sister and I have a house, each 50% ownership. My sister wants to transfer her 50% shares to me. However, the property tax would change because of the new ownership. We don't want to pay more property taxes. Can my sister give me her 50% as a gift? Would that make any difference?
Well, this probably I can answer as a gift part. Yes, you can give her as a gift, but you need to file gift return to qualify. You don't pay any tax. By filing the gift tax return, normal people can exempt paying the gift tax, because anything you're giving more than $15,000, there's about 30 to 35% gift rate. But you can you use your lifetime limit. So I remember on last week we talked about the title. The quit claim deed allow her to exempt to pay to be access the property tax, right? So the only way you don't pay higher property tax is through the quit claim deed, as a gifting. Yes.
As gifting, okay.
Mhm.
From Harry to Bin, I just signed a contract to purchase a house. What are the tax implications of closing on the house in the last week of this year, which is December 2020, versus closing the first week of next year, January 2021?
Only the interest and the property tax gonna be deductible normally, but only 1 month left. I don't think there's any big impact. It's probably there's no change. I don't know how much your other house the deduction gonna be. The property tax only 10,000. The mortgage should be another $14,000. If you can pay $14,000 mortgage, then close in the current year, then you will get more deduction.
Okay. From Frank, if you are a W-2 employee with income back-end loaded, can you also make estimate tax payments by January 15, 2021 to avoid under withholding penalty?
What do they mean back-loaded? Means back-end loaded.
Back-end loaded.
So that means he gonna get a big bonus check, right? So if you have a bonus check, the money may be deducted already. So you can also wait to January 15 to calculate your estimate tax. Just remember, the subject to penalty if you paying too late. But if you back-end loaded, means you earn your majority income towards the end of the year. So you need to be prepared 2210 form, which is a penalty form, to document every quarter how much did you make to lower your penalty.
Okay.
But my suggestion is to use your bonus check. If back end means he has a big bonus check, to defer there. There's not too many dates difference. You pay at the end of the year, and the 15, it's only 2 weeks difference.
There's another question. I'm not sure it's together. I'm sorry. So due to the withholding holiday in 2020, will the IRS eliminate under withholding penalty for 2020?
I haven't heard anything yet. So I think the penalty is still gonna be there.
Okay.
I don't think it will be gone. You shouldn't rely on that. You should pay as if they are still charge you penalty.
Mm-hmm. From Nima, what tips do you have for a landlord to pay less rental property tax?
You should do the record keeping well, so every rental track and any expense. Normally IRS allow all the rental expense to be deducted against the rental income over there. And if you want to lower it again, just from my experience, a lot of self-preparer, they never took depreciation. Either they don't know or they don't want they don't want to take the depreciation, which I think tax-wise are wrong recommendation. You should always take the depreciation. Depreciation can help you lower the rental. So if you already do all your work, track every expense, you make sure you also clean the depreciation to help you lower the rental income there.
Okay. Is somebody sharing the screen? Not
I
sure.
think so. That's why I can't see the.
I know it's hard to see. So let's see who's sharing. Maybe.
Can you stop? Somebody stop.
I think Wendy.
Huh?
Wendy is sharing screen.
Zoom.
Okay, great. Thank you. So from Phyllis, if you have stocks, can you transfer stocks to Roth 401k, or do you have to sell the stocks and then move cash to Roth?
I don't know if the stock already in the RA or in the 401k. I would think what she meant is in the taxable account. In the taxable account, you cannot, okay? You only can do the contribution. I don't think, unless your brokerage allow you to do the income, the stock transfer from. So let me just assume what she means is the stock in the brokerage account. Unless you can do the contribution to the Roth IRA, which is subject to income limit, you cannot transfer to Roth IRA, okay?
Got it.
Yeah.
Okay, from Z, if you are self-employed, can you contribute directly to a solo Roth 401k plan since Roth IRA? If so, what is the income limit and contribution limit for 2020?
So the question is, if you are self-employed, you don't have to do the transfer. You can make up your mind you want to do the pre-tax deduction or the after-tax deduction, because you're allowed to set up your 401k have a Roth capability. You know, you can put all the money all the way to $57,000 to after tax. The only way people want to do the pre-tax before then to do the conversion is they don't know how much money they want to deduct it. So they do the contribution in pre-tax. After they finish the tax return, they saw they have a lower tax, then they converted the pre-tax to the after tax. But you're gonna pay tax in next year, you know. So my recommendation still, if you are self-employed, solo 401k, just make up your mind which one you want to do the pre-tax or after tax, you know, then do that way. You don't have to do the conversion, you know.
Is there an income limit or contribution limit for 2020?
Income limit is a 280K for the qualified plan. RIS only allow the income limit. So any income, as long as you don't make income more than $280,000, the 19,500 can be deferred to a 401k plan. And the 25% of your W-2 or self-employed income is deductible. Self-employed income actually 20%, you know, so.
Okay. From Inbo, how can college students use their internship salary to contribute to IRA or even Roth IRA? How much can they contribute?
They can contribute, as the charter said, about $6,000, as long as internship is paying the Social Security, right? So as long as they're paying the Social Security, up to $6,000 can be deferred. And if they don't pay tax, I recommend they put into the after-tax Roth IRA. Don't put it into traditional IRA. It will yield much better benefit in later of their life, you know.
Okay. From Keqin, for people's company in other states but work at home in California this year, do they need to pay two states' taxes?
This is in debate right now, I would say really take a look at your W-2. How do they hold the W-2? Some state thinks if you living in their states, you earn the income in their states. I think California think that way. If your employer in some other state, but you living in California, California wants you to pay the California tax here.
Okay. From Lillian, can capital gains be used to offset the total cost of 6,000 plus pound vehicle purchase via 179?
Of course not. They are not earned in income. The capital gain is only, so what he said that the car, can they offset the capital gain, right?
Yeah.
Well, not directly, at the least. You cannot say I buy a car and I make a lot of money and the stock, can they deduct it? Of course not. But you can report the bonus depreciation on the Schedule C, then have a Schedule C generate the pure loss. Those ordinary loss can deduct other income, including the capital gain.
Okay. From
It's doable though, but they have to demonstrate how do they get the business loss.
Okay. From Inbo, shall we start selling stocks before 2021 for good capital gain taxes, I guess, in preparation for Biden in power?
That's one of a strategy, So if you think the capital gain gonna go to 28%, which Biden is a proposal, I didn't put my chart over there. Then you should sell. But still, as a financial planner, I always tell the client, don't let the tax tail wag the dog. That means you shouldn't take a look at the tax. You should sell based on the market condition, not really on the tax wise. There's only maybe 15% to 28. It's a 13% difference.
Okay. From Keqin, is long-term capital gain tax bracket applied to W-2 earlier as well? Is long-term capital gain tax bracket applied to W-2 income?
Yes. If your W-2 income is higher than, let's say 37%, you're gonna jump to another tax rate, so 20%. So any income you make from W-2 will push up your total gain. When your total gain is put you into the 37% tax bracket, then you pay 20% of capital gain there.
Okay. And then from Rupa, will long-term capital gain be added to the AGI and will it increase the tax bracket?
It's similar to the prior question.
Mm-hmm.
Yes, the answer is yes. Yeah, W-2 will add to the AGI and will push up your taxable income, and it depends on your taxable income, then you can take a look your rate. So let me go back to share my slide there. Let me see if I can find my slide. So I want to, let me see. So I just use this one. So this is the capital gain rate, okay? So let's just view it a bigger fit. Jesus, I don't know. Can you see the rate? Let me.
No, you are not sharing.
You have to share your screen.
I haven't shared my screen yet.
Not
No.
yet.
Okay, I thought I shared. Okay, okay, I'm sharing now. Let me see. So this is the slide, and then let me swap it. Can you see it now?
Mm-hmm.
Yeah,
Yes.
Captain Dean. So your taxable income will determine how much tax rate you will add. So if you have a W-2 income and they make your taxable income, you're landing for the single over 441K, you pay 20%. If for the couple almost over $500,000, you pay 20% there. So is that clear? So that means, so in the last two questions, they all ask about the W-2 income. Will W-2 income determine how much tax will pay on the stock? The answer is yes. If you make more income, you become a higher tax bracket. When your tax bracket over 400K for this, 441K for the single and 497.6K for the couple, you will pay 28%. And since all your income is over 200 for the single and the 250 for the single, there's another tax called the Obama tax, 3.8 will add on the top of a 20% here. And the California is about the 10%. So for the couple could be as it's almost at the 34%, you know. So this is I always tell my client, if you make too much money, a third is not going to belong to you. You know, it's become to the government anyway on the stock sale.
Okay. From Kathy, I don't know Coco's WeChat. Can you post? My WeChat QR code is right here. And this is my WhatsApp, and this is my YouTube channel. I posted in the chat as well. It's Coco 10 Real Estate. That's my WeChat ID. From Nima, can you share how to join tomorrow's meeting regarding capital gain? So that's going to be, it's a different way of joining, right? Being it's not.
Yeah, I invite a specialist, so they have a way to share it. So let me bring in my 2D barcode over here. So that will be the code here. Okay. Can you see it?
And that's
Yes.
yeah. Mm-hmm.
Okay.
And then WW says, sorry, came to today's Zoom a little late. Would you please show the slides before what to consider tax deduction by end of the year? So there's a slide before that.
Okay. So let me put it, blow that up a little bit. So this is a code for tomorrow, and he wants to see the deduction by individual.
What to consider tax deduction by end of the year, but the slide before that.
It's over here. Okay.
We will also have a YouTube recording as well. So we can send it to everybody. If you can send me an email, or you can go to my YouTube channel, and you should be able to find today's. Yeah. Okay. From Jenny, for HSA contribution, if employer contributes 50% of 2020 year it's flexible HSA allowance, then can employee contribute the rest of the allowance?
Yes, you could. So the HSA limit are here. If for individual 355, your employer contribute $1,775. Then you can contribute the remaining 50%. If for a family, you have a family, as long as you can contribute up to $71K, $7,100, it should be allowed. You just didn't get you just didn't report it on the W-2. You report it on your 1040 form. You know.
Okay. From Rupa, if we use HELOC from primary home and buy rental property, can I deduct HELOC interest for tax?
Yes, if you can do the expense tracing, that's a tax term. Means if you can demonstrate that the HELOC money directly help you to invest the rental, then you could claim it on the rental deduction.
Okay. For WW, for foreigners who are not living in the US, when they sell the US real estate, is there any way to save taxes?
It's the same way as American, how Americans save, they will save. So basically, you can deduct all the rental loss on the property. Do they say rental? Do they, or do they say
Just property.
just
Well,
property?
if they don't live in the US, then their
Yeah,
property
If
probably.
they don't live in the US, the property have two situations, either empty or rental. If empty, you only can deduct whatever the buying cost and the fix-ups cost. If it's a rental, you can add in the rental loss, So it's the same way as an American,
Okay. So are there any gift tax or other taxes if gift the home to relative in the US during his lifetime? What is the gift tax rate and when do we need to pay for it?
Well, gift tax rate, if you, the gift tax rate at least 30% all the way to 40%, depending on how much you will give, okay? So a lot of people, if they give any gift more than $15,000 in any calendar year, IRS require you to pay gift tax on the gift tax return, or you can elect to defer those tax using your lifetime gift limit, which is currently $11.4 million. So just on the side notes, a lot of affluent people think about the give up to utilize that the 11 million in this year to grab the 11 million because Biden could decrease the lifetime gift limit down to 3.5 million, So
Start giving money away.
start the money away to give to the second or third generation. Keep the money in the family, without being taxed.
Okay.
So that answer is they have to file the gift return,
Okay. From Shirley, for W-2 earner, what is the difference to use last month's withholding versus pay estimate tax to make the additional tax you might owe?
You shouldn't use only one month. You should take a look at your year-to-date contribution. Take a look at your paycheck, your most current paycheck year-to-date number to figure out, to annualize how much the withholding tax you already pay. If you short from you supposed pay, I already said supposed pay is 110% than the last year's money. So you should come up the difference to avoid the penalty,
Mm-hmm.
Unless you make it very significant, then you need to do a projection how much tax you need to pay for 2020. Then the rule is you pay 90% of what you would be paid when you file the tax return.
Okay.
It's hard to predict,
Okay, from LW, this is for rental property, paying off mortgage, already paid off mortgage years ago. If cash out refinance now, would the new mortgage expense be tax deductible?
Yes, if they still living in the same house, the refinanced have the two limit. One is up to their purchase loan already they initially bought, or to the 750 loan, depends on which years higher.
Okay.
So you can refinance all the way to your original purchase loan.
So anything beyond the purchase loan is not tax deductible then, right?
Yes. No, they are not.
From Wendy, for college students, under what situation for parents to claim them as a dependent would be no more tax benefit based on parents' income, or if the student has some earned income, what is the maximum amount for students' income to not qualify them as a dependent under parents' tax return?
I think I get what she said, but I think I should leave my notes over here. So basically, she asked if the parents should claim her as a dependent. Okay, so the trick is how much tax she would pay. You know, so normally you need to prepare her as an individual, and the parents compare if take her in or not. Okay, so basically it's all boils down to this deduction over here. It's a 500. Oh, okay, we didn't show over here. So she already says she is a college student, so she is over 17-year-old. So 17-year-old, the child tax credit is only $500. Okay, so if she can get more than $500, her parents should not claim her as a dependent anymore. Okay.
Okay.
So in this year, if you can file independently, get $1,200 for the stimulus check, then you should file independently.
Oh, for the college student to get the stimulus check, right?
Yes.
Mm-hmm.
And of course, the parents cannot claim them to lose that $500, and another $200 somewhere for the California. And the parents' income should be under 400K. You can do this comparison. If a parent's income over 400K, then they cannot claim the dependent anyway. The kids should file independently.
Okay. From Nima, for keeping all the rental property records, is there any other benefits besides deductions, besides being able to deduct all the expenses? Any other benefits?
Benefit. Well, the benefit is to pass RS audit, you know. So I don't see anywhere else why I need to keep so many. So anything you deduct against your earning, no matter for rental or for business, we normally recommend put at least 3 years, the better, up to 7 years. You know, after 3 years, you can throw all the original receipts away, but your worksheet or everything you should keep 7 years, because a statute of limitation run out the 6 years from what you file. So from what happened, it's gonna 7 years, you know.
Okay. From Kathy, for self-employed, is solo Roth 401k better, or SCP SEP IRA better? Which one's better?
Of course, 401k is better, because 401k can deduct 100% of your self-employed. SEP only the 20% of what you earn.
From Baoqing, for backdoor IRA conversion to Roth IRA, can I do it in phases to lower the taxes, or do I have to do the conversion in one shot, which would push into higher tax bracket?
I get lost somewhere. I try to close my window over here. Can you repeat again?
Yeah. So for backdoor IRA conversion to Roth IRA, can I do it in phases so that I can lower the taxes, or do I have to do it? Do I have to do the conversion in one shot, which would push me into a higher tax bracket?
Well, the direct answer is if you can do the conversion at a lower rate. Normally, my rule of the book is under 25% rate. So normally, if I do the Roth IRA conversion, only 25% the tax I would like to pay. So don't do it in lump sum because it's gonna push your higher rate, you know. So if you can do from the traditional IRA to the Roth IRA, under 25% rate, it's maybe makes sense. If you do a lump sum, it can push you to the higher rate. So do it gradually, you know. I don't know. She has another. She said from the non-deductible RA or from the traditional
The
RA.
backdoor IRA.
Backdoor. So the backdoor RA is the key question about the backdoor RA is you don't have a traditional RA. Okay, if you have a traditional RA in the total amount, it doesn't work. Okay, because there you have to watch out the proportion rule because backdoor means they contribute as a non-deductible RA, then converted to the Roth RA. But if you have a rollover RA on the side or for those all traditional RA, RS is calculated proportionally, you know, so it doesn't really work, you know, to do the conversion. So you really need to get the professional help because a lot of my clients, what I see, what they did was wrong. You know, they just compartmentalize their thinking as I only converted the non-deductible RA. Why they have a 100,000 or $500,000 traditional RA? You converted $5,000 out of a $500,000, only 0.1 are tax-free. You know. So it doesn't work, you know.
Okay. From Nima again, can you please explain one more time about the quitclaim deed? Can my sister transfer her 50% ownership to me without our property tax basis being changed?
Yeah, quitclaim deed. Well, I'm not an attorney, but according to what I talked to the attorney, quitclaim deed is the one of method to exempt you to be assessed by the property tax. Maybe you should consult the attorney or the title or the county too. So if you don't grant deed, you just quitclaim deed, it's considered as a gift, you know, and it doesn't trigger the reassess of a property tax, but it does trigger the gift tax on the RS form. Okay, so go one more time is you're quitclaim your sister 50% to you, she has to file the gift return.
Okay. Okay, from GC. We inherited a portion of a house in 2020 and was able to step up the value according to our lawyer. We sold the property at a small loss. So can we avoid paying any taxes?
Is their primary home? Is this primary home or second home?
DC?
Doesn't matter unless it's a rental home. Okay, if it's a rental home, the loss can be claimed. If it's a primary home you sold at a loss from your step base or your second home, RS doesn't allow you to deduct any loss. So in the primary home and the secondary home, the gain are taxable, the loss are not. But in the rental, the loss is allowed to deductible.
Okay. From Jenny, what's the difference in tax advantage for employer if I hire my own child under 17 and over 17 years old? That's the first question.
If he is self-employed and the kid is under 17, the benefit is you give him whatever the amount, you don't need to pay the payroll tax. Means no Social Security, no Medicare, no unemployment tax. no SDI or whatsoever, okay? But over 17, when they 18th birthday, they have to pay all those payroll tax. And if you pay them under the standard deduction, like $12,000, it's almost tax-free, you know? So nobody pay any tax. The kids doesn't have to pay, you know? It's one of a strategy the self-employed owner, our self-employed owner is doing though, but I recommend them they have to have a good proof the kids is working for them, you know.
Okay. The second question from Jenny is, can I put my capital gain from stock to Roth IRA?
No, there's you have to be earned in income there. If you have a stock gain, they are not eligible for the Roth calculation. No.
And there's a question from the other platforms from David. Converting from traditional IRA into Roth IRA using stocks, what's my tax consequence in year 2020 and later when I sell them?
From traditional RA to a Roth RA, you always pay at your marginal tax rate. So I said at the beginning, I only would like to convert at 25% no more, you know. So just remember to take a look how much tax rate you will be, and you only have a 3-week left to do the conversion. So you basically should be sure how much tax rate you're gonna be at. The federal combined to the state. If over 25%, normally it doesn't make too much sense, you know, unless you are really, really young, you know, you have many years to grow those Roths. So if they sell the Roths from the traditional, they cannot sell 5 years from the conversion. Otherwise, it's still gonna be taxable, I guess, because every Roth have a 5-year rule you cannot sell, you know.
Okay, from WW, would you please show the slides? Oh, this is actually, we did this one, okay.
Okay.
Rupa, what's the maximum amount parents can give their kids in a year? I think you mentioned that earlier. It will be reduced.
Yeah, they talk about the gift tax. Anybody can give anyone $15,000 without the triggering the gift tax, you know. So
The question is, what's the maximum amount parents can give their kids in a year?
$15,000 per parents can give $15,000 if they combine the $30,000.
Okay. From GC, how do you do the calculation mortgage interest deduction if the loan amount is greater than $1 million?
Then use if your grandfather in before December 15th, 2017, when the Trump's changed the rule, $1 million. It's always $1 million. Sorry. So if you have a primary homes mortgage as $1 million, the calculation is use $1 million divided by whatever the loan balance in the beginning of the year. And some CPA argue they should you use the average loan balance for the year, which is the beginning plus the ending divided by 2. So 1 million divided by the average loan balance, whatever the percentage applied to the amount on the 1098 form is your deduction.
Okay.
And divided by your loan balance is what you can claim for the deduction.
Okay. I have a few people ask for the presentation slides for today's seminar. So maybe Mr. Bin Zhai, you can email me and I can send it to them. Okay. And they also ask for tomorrow's seminar information. Okay. In the end, Bing will show it again, and then maybe later on, since that's part of the presentation slide, then you can get it as well. Yeah.
Okay, I will send you a code.
Yeah. A, can you elaborate on the donation strategy for tax benefit purposes?
Okay. I talk about the bunching, right, on the slide, So when you have an itemized deduction, the donation is only deductible on the itemized deduction. But the problem is a lot of people is not qualified for the itemized if their total itemized is not over $24,800. So the only way to get the deduction is they donate a lot of money. So, but if your donation to you is a lot, but when we prepare tax return, it's still not over 24,800, then the standard, your donation is basically for the tax purpose only, is go wasted, So I normally recommend my client is maybe you can donate the next 5 years what you want to donate in the current year, put them together to jump your itemized deduction to be higher. And so they ask what's the strategy to do the donation? Is that right, Coco?
Strategy for donation for tax benefits.
Well, this is, I talk about the itemized deduction. And another way to take a look, IRS allows 60% your income to be donated. So take a look your taxable income, 60% is donatable and deductible. So you can donate everything you earn, or otherwise to be taxed 60% to the public charity, 40% to the private charity. And it's also matters if you donate the cash or non-cash. Cash is always higher, non-cash, like you donate the clothes or household item. I think the highest the donation level is no more than 20 or 30% of your income, depends if you donate to the public charity or private charity, like a private foundation kind of stuff.
Okay. So WW, you're asking where you can find my YouTube channel and my WeChat ID. So I just dropped my WeChat ID in the Zoom. This is my WeChat on my wall, and this is my YouTube channel, and that's where you can find all the videos. You can subscribe to my YouTube channel, or you can email me. I send you a link. All right. So next question is, what is the minimum age that you can employ your child?
I don't know. As long as the child can work. Shirley Temple was hired at 3 years old, right? So, but normally it depends on how you can document that your child is working for you, So normally just some discussion among the CPA. We think when kids turn teenage, maybe the good year you can hire them, Before teenage, they are not capable to do the office work. Probably,
Okay. So following that question, can a child under 17 years old who has W-2 income participate in 401k plan?
Yes, of course. I always say, I talk to my kids, says I pay you to work. Then if you put in 50% into your Roth IRA, then I will match dollar to dollar, So that's how you put the money forever to be tax free, So you
Okay.
pay them $6,000, they contribute $6,000 to a Roth IRA, then the money gonna be forever tax free, right?
Okay. So back to Nima's question, when my sister wants to file the gift tax return when she gifted me her 50% interest of the ownership of the house, what amount should she report? The cost base of the property or the fair market value of the property?
Fair market value. You should hire an appraiser to do the fair market value.
or even a broker price opinion, right?
Nina, I think you asked 3 times about the same question. Maybe it's a good time in next year you file gift return with us. Don't normal
Time to
people.
contact with the CPA.
Yeah, you should really consult a CPA to do this. Normal people doesn't know how to file the gift return.
Yeah.
And what she gave out was the fair market value, but she also carried the base of the house. So when Nima sell the house, she will report the original gain, whatever the gain. She only give out the fair market value, but Nima still carry the cost base. So she still need to pay the gain, when Nima sell the house.
Okay. From WW, do you know the minimum self-employment income in 2019 or 2020 to qualify PUA?
PUA is a pandemic unemployment. I'm sorry, I'm not the expert on that, So you should take a look at the EDD website, Normally, PUA is, I think, you only get $400 for every week, Well, no matter how much money you make, the EDD, the top limit is 400 every week. It's about $1,600 every month. So if you talk about the minimum, it's about the poverty line, $20,000 or $25,000. You probably can qualify for that much money,
Okay. Next one from Nate. Should I give W-2 or 1099 to my own child to get exempt from tax? The income limit is under $12,000.
Yeah, they have to document they pay normally on the W-2. Yes, payroll check and the W-2, and
Okay.
they have to file all the payroll return. Although it's 0, then you still have to file. And if you need that kind of work, our firm can handle that too.
From GC, how do we contact Mr. Bin Zhai to ask further questions and for consultation? So, Bin, you can show your number again, or GC, if you want to contact me, I can also connect you with Mr. Bin Zhai as well.
Sure.
You can
Yes.
show your information. Yeah. Mhm.
I will share the slide on the first page of my slide. So,
This year is, I'm not sure about this question. There's a, from Ken, this year is 100%. I guess it's an answer for somebody, right? Justin just dropped the YouTube link, and that's the YouTube link in Zoom. And that's where you can find all the past events. And coming up, we have investors medley. So basically a lot of topics for investors, including 1031 exchange and different types of companies, S Corp, C Corp, LLC, what those companies are for. Are they for tax savings or are they for liability? And also property management for long-term rental and short-term rental, as well as eviction during pandemic. So we have those serious topics coming up. So if you wish to subscribe to the YouTube channel, the link is in the Zoom dropped by Justin. From GC, calculations on inheriting a portion of the house in 2020. It was never rented. That was for the question earlier. Our lawyer said we could step up the value. We, meaning the siblings sold at a small loss in 2020. Question is, do we need to pay any taxes on the sale of the house? Not trying to deduct any expenses. Just want to find out whether they need to pay any taxes. Bin?
they have to report it. Well, if so she's
Overseas. They're overseas, never
rented, right?
Yeah, never rented. Yeah. Mm-hmm.
So it's never rented, and you sell the house. You have to fill in the form 4797, because every time you sell the house, the escrow company will send the IRS 1099 S form. So IRS only knows how much you sold on the house. And you have to close the loop to report how much sale you have and how much base you have. The form, I think, is 4797. And it depends on if you have a gain or loss. I already said in that situation, if it's never rental, the only possibility is your primary home or your secondary home. So you have to report it to demonstrate that you don't have a gain, you know.
Okay. There's a question, what is the lowest income amount to get the full 4 points Social Security for a year?
I would say $6,000 somewhere, okay? So I remember it's about $1,400 every point. So every year you need to work around $6,000. W-2, okay. So you make W-2 income more than $6,000, you will earn 4 points. If you're self-employed, I think it's around $6,600 somewhere, you know. It's very small money, you know.
If your child is your dependent and you do not qualify for Roth IRA,
Yeah.
would the child qualify for IRA?
Yeah, if they have earned if they have earned the income, they will qualify. Like babysitter money, the newspaper deliver money kind of things, you know. If they have earned the income either from outside or from the parents has to have a self-employed income. Then if whatever the amount to make is how much they can contribute to the Roth IRA up to $6,000.
Okay, great. That's a lot of questions. I'm so glad that you actually went through all of them. So
Yeah,
information is on. Yeah. And if anyone try to get in touch with us, then you can feel free to email us as well. Thank you so much for sharing with us, Mr. Bin Zhai. And thank you for all the viewers for joining us and participating as well. We sure learned a lot about tax planning. We welcome everyone to participate in our next seminar. We will now stop recording, but please feel free to stay to chat or network. If you still have questions for Bing or me, and it's very specific for your situation, feel free to stay. Mr. Zhai, I really appreciate your time.
Yeah, sure.
Everyone will stop the recording and then feel free to stay around. Yeah.
Then, thank you very much, Coco, for a good opportunity. And
thank you,
a lot
Bing.
of participants. Yeah.
Thank you.
My pleasure. Thank you.
Yeah. If you want to stay around, I'm not sure. Then maybe you have.
Maybe you can open.
I have more questions here.
Okay.
So WW said, foreigner not living in US but not renting out the house, can it be considered as a primary home to get 250,000 exemption?
Of course,
actually,
not. If they are not living here, no way.
No, but the foreigners don't have the 250,000 capital gain exemption anyways.
They could if they live here.
As a primary home.
Yeah.
No, I think the 250 is only, it's not for foreigners.
If they live here more than 183 days, they won't be a foreigner anymore.
Oh.
They are resident alien. You know, you need to start to pay US tax worldwide. I wouldn't think anybody want to live here to pay any tax, otherwise they don't have to pay, you know.
Okay.
So you try to gain the 250 million, RS has another way to have you pay more, you know.
People asking for tomorrow's seminar information again. Yeah.
Okay, so let me scan to the code. So here, if you can take a picture or just, yeah, if you're using iPhone, take picture, and the iPhone can direct link to the 2D barcode for tomorrow. We use MS meeting. They are not on Zoom, you know.
Next time you can just convert to Zoom, make it easier.
I don't have a Zoom account.
Oh, okay. So yeah, I can help you out. You're my distinguished partner. Okay. From Kathy, what is the 250? It's 250, not 259. 250,000 exemption. So for single person, if it's primary home, then when you sell the home, you can have capital gain exemption for up to $250,000.
Yes, up to 250. They have to prove they own the house for 2 years and live there for 2 years within the last five years before sale.
Okay. From Nima, if the landlord does everything and keep the record, there's something that IRS called something. You even mentioned that a long time ago in other meeting. Do you recall? Do you know what that means? Landlord keep everything, keep the record. That's IRS.
I don't remember. As long as you keep the record that can pass RS audit, that's all you need to worry about, right? So we just call the record keeping though, you just keep all the receipts. Oh, she talk about the 20% exemption?
No, Nima. Remember Nima asking for landlord keeping the record. Yes. Nima said yes. Okay.
Yeah, the landlord, okay, those costs is still in the part of a 199 deduction A. So the rental house gain is also exempt for 20% deduction. If you work in the house more than 250 hours, you have to document the time log, okay? And it's not only you, everybody, the gardener, the repairman, the property manager, if they can accumulate 250 hours on your house, and again on your house are exemptable. You need to file a new form called 8995A to get the exemption. So 20% are exemptable.
Okay. And then I have people saying that they cannot open up the barcode for tomorrow.
Yeah.
Any other way to join the meeting? I think that's it.
I can send an email. Can you guys send an email either to me or to Coco? I can send a link.
Yeah. Okay. Yeah, you can send an email
I
to.
tested the Ken, although I haven't hosted the meeting. Maybe I'm the hoster.
I think just that they have to download another app. That's what it is.
Yeah, they need to
Oh, it's
download.
open,
They
yeah.
don't have to. Microsoft Teams can be open in the browser. You don't have to download.
Oh, I thought okay. I was scanning earlier. I thought I have to download something, but I didn't look further, so that's fine. Yeah.
Right. It asks you to download the team if you using a phone. Okay. Yeah.
Okay. So so Bing can email me the slides to me, and I can email.
Yeah, I will email you right now. Okay.
Yeah. So anybody who wants the slides, please email me at cocotangroup@gmail.com. Cocotan, COCOTAN, group, GROUP @gmail.com, and I will email to you for the slides and also for tomorrow's meeting link. It has been a very long meeting today. It's supposed to be 1 hour.
Yeah, I'm surprised people like know the boring stuff so much.
You think boring, but it's very useful.
Yeah, it's useful. It's everybody's pocket money, right?
That's and it's about to hitting the end of the year. So this is a just-in-time seminar for us to know how to save more money, so we don't have to pay that much.
Try to and yeah, I just want to tell anybody the tax is a very individual things. Over here we only can give the general information. You already can tell with so many question here. A lot of answer are really depends on what the situation you have. So we are CPA. Just let me do some self-serving advertising. We normally the first consultation within 20 minutes for the new client are free. If you become our client, we normally give the give a client two 15 minutes free time to do some tax planning for some straight situation. All those half an hour should take care of everything. So it is good if eventually you have a tax accountant can help you to analyze the situation. So.
As you can see, Bin has been very generous with his time and the knowledge. So he does this for every client and also followers every year. So this is year-end one. I'm sure I'm going to have a beginning of the year one for everybody to kick off the new year and do a tax planning. Yeah.
Okay. Yeah, sure.
Any other questions? Anybody wanted to? We love avoiding taxes. Yes. Everybody wanted to not
Legally
pay.
avoid the tax.
Legally avoid taxes.
I know a lot of rule is illegal, but so
A lot of rule that's illegal. That's
there's a lot of people doing things you cannot imagine how they want to do it.
That's
So,
right.
but they should do it legally.
Right, correct. Yeah. So stay tuned. For the new year, I'm kicking off this investors medley, and that will be for all the topics that as an investor you wish to hear. So once again, have 1031 change and different types of companies set up how to hold the title for your investment properties and property management for long-term lease as well as Airbnb short-term lease, and also the eviction during pandemic. So, and we're also thinking about having a seminar to talk about which areas to invest. So I will be sharing some area information. Hopefully will give you some guidance in terms of where you should buy as a good investment. So stay tuned.
So Coco, I send you tomorrow's link and my attachment already. Okay.
Okay, great. So anybody who wants this information, you can email me, or if you have Bin's email, you can email him directly. If you email me, I'd definitely forward the information over to you.
Yeah.
And if you want to join Bin's tax chat group, you can add me and I will add you.
Yeah, so sorry, I use overdue. Yeah. So this is also our website and the email, if you can see on the slide. Okay.
Okay.
All right. Thank you, Coco.
Thank you very much. Thank you, Bin.
Okay.
Have a good night. Yeah.
Thank you.
Thank you.
Thank you.
Oh, how do you comment? One more thing. Are you here?
Okay, I'm here.
How do you comment on president's tax returns?
My comments is he got a lot of attorney and the CPA to help him, So he knows much better than everybody else. The current president, right, doesn't pay tax for only pay $750, So.
But I'm sure he got a lot of protection. Yeah. And then
yeah, I heard he has a lot of company. If you sue Donald Trump, you have to sue 8-layer company before you can sue Donald Trump himself.
Okay, so he has his protection. So that's one of the things we're going to talk about, how to set up a company to protect yourself. But of course, different type of companies have different type of usage. So we'll be talking about the different types of company, what the best use.
Don't want to waste our hard-earned money on the structure,
That's
we should enjoy our money, not to set up a fire or to prevent somebody to sue you,
Yeah. So WW, you said, could you type your both emails here? I typed my email here, coco10group@gmail.com, and Bin's email is actually on the screen. He's sharing his screen. His email is on the screen.
Yeah.
The next one is Nima, safe harbor. That's what I was looking for. So do I need to put 250 hours to get qualified?
You and everyone work in your rental house, you should be able to document they put 250 hours, safe harbor. Yeah.
Yeah, I have some private messages to me to ask for the slides and recording. So if you could leave me your email, I will make sure I send it to you. Or if you could email me, just because I saw your name on the screen, in case I mismatch the names and emails. So please make sure you leave me your email or email me at Coco Tan Group. I will make sure to email you back with the slides today. Okay. All right. So it looks like this is today. Thank you again so much, everyone. Good night, and look forward to have you join us next Tuesday. Not 2 weeks, but just this following Tuesday, December 15th, talking about Proposition 19.
Yeah, that's really important one. Yeah.
Yeah, that's a very important one. So, Bing, will you be on board?
Yeah, I will be there. Yeah.
To be here. That's great. Yeah, because I think that has a lot of changes. But I believe you can actually move up in value and keeping your property tax bases
Yeah.
with that, which is a great move for a lot of sellers. Yeah.
Yeah. Okay.
So what is the info for December 15th? It's the same Zoom, Kathy. Just dial in 408-829-6053. That is my phone number. And password is Coco, C-O-C-O, lowercase. And if you can send me your email, I'll make sure you get an email link as well. Hi, Bing, do you have WeChat? Yes, Bing has a WeChat, but his WeChat QR code, that group expires. So if you want to add me, I can add you into that group.
Yeah, sure. Thank you.
So he does have a WeChat, but just give you a warning. I don't think Bing checks his WeChat very often.
Yeah, sorry.
So it's good to join our meetings live, but he doesn't. He has a WeChat, but he's on that WeChat group. He doesn't check his WeChat very often. Yeah.
Yeah. Yeah.
I feel like I'm your assistant, Bean.
Thank you to be my assistant for today. Thank you so much for your moderating. Very good.
Yeah. No. I mean, like, to get your people in there because because you don't check your WeChat messages very often. Yeah.
We don't do business through WeChat. You know why, right? Yeah. Sorry about that. Yeah.
I do my business with WeChat.
Yeah, you guys do a lot. I think so. I'm so afraid of my clients sending me any text document through the WeChat.
It's not safe. Yeah. Agree.
I
Yeah.
really afraid.
Yeah. And I have people actually private WeChat, not WeChat, messaging me to ask me to email the tomorrow's information and slides. So once again, please email me because I wouldn't know your email address. So please email me cocotangroup@gmail.com. I make sure to email you the information. I got some people's email here. Yeah. Okay.
Yeah, our tomorrow's meeting is really, supported by our clients. We realize a lot of people, they make a lot of money on the capital gain. So we think the strategy we have here maybe can help some client. At least learn there are some ways you can save on the capital gain tax.
Yeah, backed by popular demand.
Yeah.
Okay. I want to make sure I catch all the questions. If you don't hear your question being called, I may have missed it. Then I really apologize. It's just a lot of questions I'm trying to go through and make sure I don't miss anybody. Lillian Sha. Lillian, if you want my QR code, it's on my wall. It's being, if you unshare, then you can see.
Yeah, Lillian. Yeah, I think Lillian called me in the afternoon. I was busy, So, yeah, Lillian, if you can hear me, I'm probably gonna call you tomorrow. Okay.
Are we talking about the same Lillian?
Yeah, I think so. Lillian, yeah.
Yeah. So if you
have
So
my
Lilian, my
client sheet.
WeChat, yeah, my WeChat QR code is right here on the wall. I'm not sure you can see it. If you cannot, it's Coco 10 Real Estate. That's the WeChat ID.
Right. Okay.
Okay. And Lilian, if you want to receive the slides, I need your email. So anybody else?
Sure. Okay.
Are you
So
still in the office, Bing?
yeah, I think I'm okay. So
Okay, thank you so much. Sorry to hold you so late in the office.
it's okay. Yeah.
Okay, Lilian, got it. Yeah.
Okay.
Lilian, do you get it? It's Coco 10 Real Estate. So if you wish to receive the slides, you can send me your email and you can message me your email or send or email me. I email you.
All right.
Okay.
Okay.
Great.
See ya. Bye bye.
Bye. Have a good night. Okay. Bye bye, everyone.
Yeah. Bye bye.
Bye bye.
Bye.
Bye.